Look at your screen. Silver is trading around $71. We were at 77 just one trading day ago. That's a $6 airstrike on your portfolio in less than 6 hours. Every refresh is more red. Your P&L looks like a crime scene. Social feeds are screaming the same thing. The bull run is over. Silver is dead. Get out now. No. What you're watching tonight is not the death of silver. It's the annual ritual sacrifice of price to protect the balance sheets of the world's biggest banks. For you, today is just December 31st. For a global bank, today is Judgment Day. At exactly midnight, regulators take a single frozen snapshot of their entire balance sheet. Every ounce, every contract, every sliver of risk gets locked into one frame. That frame decides their G-SIB score, their Global Systemically Important Bank rating. And that score decides how many billions they must lock away as dead capital for all of next year. Imagine someone telling you, either you freeze $10 billion for 12 months, or you dump anything that looks remotely dangerous before the clock hits zero. What do? You do not argue. You hit the eject button. You throw every volatile asset overboard. And silver sits right at the top of that list. It moves fast, it moves hard. On a risk dashboard, silver is a seismic fault line flashing red. So in the last hours of the last trading day, the risk desks pull the same lever every single year. They flatten their metals, cut their derivatives, unwind their leverage, and convert everything they can into the quietest thing the regulator understands: dollars sitting still on a screen. That's what you're actually seeing in this crash. Not the market deciding silver is suddenly worth less. It's a handful of risk officers trying to make one regulatory number less ugly before midnight. Now layer on the second ingredient: volume. Half the human traders are already checked out. They're on planes, with family, or already drunk. Desks are running skeleton crews. Liquidity is as thin as oxygen near the top of Everest. When you try to push institutional size through that kind of market, prices do not slide. They detonate. Move 5,000 contracts and you do not get a gentle pullback. You get a vertical candle. Move 10,000 and you rip a hole straight through the order book. They're not trying to get a good price. They're racing a clock. Speed over finesse. Deadline over optimization. Now zoom out and watch what happens mechanically. Banks dump metals, dump bonds, dump anything with teeth, and sprint into dollars. So the demand for dollars spikes like a heart monitor in cardiac arrest. Everyone is grabbing for the same asset at the same time to dress up their balance sheet snapshot. Dollar up. Everything priced in dollars, smashed. Oil, copper, agricultural commodities, gold, silver. A stronger dollar is a wrecking ball. It does not care what it hits on the way through. But here's the part almost nobody understands. This dollar spike is not the verdict of the global economy. It's a temporary hydraulic shock in the plumbing of the banking system, caused by the calendar and the rule book, not by fundamentals. The central banks know this game. They've watched it for years. They literally built the rule book that creates it. They have emergency valves, repo operations, swap lines, overnight facilities. When the squeeze gets too tight, they inject liquidity back into the pipes. When that fresh liquidity spills in, the artificial dollar shortage vanishes, and all the assets that were smashed down by the squeeze snap back toward their real value. That's the storm you're sitting in right now. Loud, violent, but designed to be temporary. The real question is not, will this resolve? The real question is, in what position will you be when it resolves? Let's talk about the chart that everyone's panicking over. Yes, the candle is ugly. Yes, we sliced through short-term support like it was not there. Algorithms saw the breakdown, momentum funds saw the breakdown, and they all did what their backtests tell them to do. They sold into weakness. But watch what the tape actually reveals if you stop doom scrolling and start observing. Every time price tags the 71 area, the selling impact slows. You see absorption. Big bids quietly step in. Someone keeps saying, "I'll take everything you do not want, right here." That is not the behavior of a dying market. That is the behavior of informed buyers using forced liquidation to vacuum up inventory. Who are they? Industrial users who literally cannot build their products without silver. Long-term investors who understand the structural deficit. And predators who specialize in feasting on panic. These are strong hands. No margin calls, no risk committee breathing down their neck. They're not being pushed, they're choosing to act. Now let's separate the two realities that most investors never learn to distinguish: price and value. Price is a quote on a glowing rectangle, driven in the short term by liquidity, leverage, and fear. Value is atomic. Value lives in the conductivity that makes your phone charge, in the solar panel that turns light into electricity, in the industrial demand that does not care about your brokerage app. Ask yourself a simple question. Did global industrial demand for silver collapse this afternoon at 3:58 p.m. Eastern? Did the multi-year supply deficit magically close in the last 2 hours of the session? Did sovereign debt suddenly become sustainable? Or did money printing suddenly become optional? None of that changed. Only one thing changed: the amount of balance sheet pain banks were willing to tolerate before midnight. That's the spot price lie. The disconnect between the number on your screen and the actual physical reality of the metal. And the physical market is screaming that disconnect right now. Pull up dealer sites. Spot is printing 71. Logically, you should be able to buy coins at maybe 74. But you can't. Premiums are up, not down. The street is charging $10, $12, $15 over spot. Why? Because dealers live in the world of atoms, not just paper. They know this smash is a paper event in futures and derivatives, not a real liquidation of physical inventory. If they sell you real metal at crash level prices and spot ricochets back up in 2 days when the forced selling ends, they've just donated their stock to you at a discount they can never replace. So they do not. They hold premiums high because they're pricing reality, not the temporary dysfunction coming out of computers in New York and London. Now imagine the industrial side. You're running procurement for a solar manufacturer, an EV company, a medical device producer. Your budget for January assumed $77 silver. Now, in the final hours of the year, the market is offering you 71. Do you panic? No. You quietly slam the buy button. You lock in cheaper metal. You pull future demand forward. That industrial bid puts a floor under price. At a certain point, the discount becomes so absurd that factories vacuum up whatever physical exists. And here's the critical detail. When industry buys silver, that metal vanishes from the investment pool. It's soldered into circuits, baked into panels, cut into medical components. It's gone. It's not overbought or oversold. It's consumed. So while banks are dumping paper to optimize a regulatory photograph, industry is quietly stealing atoms out of the system forever. Paper risk goes down, physical scarcity goes up. That's the mathematical inevitability building under this market. Now, zoom ahead 48 hours. The year-end snapshot is done. The G-SIB number is locked. Tax loss harvesting is over. The forced sellers have fired their last rounds. On January 2nd, the board resets. Fresh capital allocations arrive. Pension contributions hit. New budgets open. Managed money that was forced to sit still suddenly has a green light. This is the January effect in hard assets. In December, markets are a narrow mountain road in a snowstorm. Thin volume, bad visibility, lots of accidents. In the first week of January, that same road turns into a multi-lane highway. The traffic flows both ways again. So what happens when a wall of new capital slams into a market that was just mechanically pushed below where the physical world is willing to sell? You get a slingshot. The farther price is yanked below its equilibrium by non-economic selling, the more energy is stored in that stretch. Release the pressure, and all of that energy converts into upside velocity. Fast down, fast up. Not because the story changed, but because the forced sellers disappeared and real buyers took the wheel. Could this be the top of the entire bull market? Could silver realistically go back to 50 or lower and stay there? To believe that, you'd have to believe in one of two fairy tales. Either global industrial demand collapses, factories shut down, and governments calmly accept a deflationary depression without printing, or the supply deficit is magically solved with new giant mines that do not exist, and geopolitical risk politely leaves the stage. Neither is a serious scenario in the world we actually live in. Every response toolkit governments have for a real downturn comes down to the same move: create more currency. And more currency chasing the same or fewer atoms only ends one way for real assets over time. So let's get practical. What do you actually do in the next 24 hours? First, stop torturing yourself with minute charts. If you're not going to sell, staring at the damage every 5 minutes is just self-harm. Second, use the quiet. Check your security, verify your storage, make sure your allocation still fits your real life, our income, your responsibilities, your sleep. Third, if you've been waiting for a real pullback, you're looking at exactly the kind of engineered flush that long-term players dream about and weak hands fear. Decide your levels before the rebound, not in the middle of it. Because when this slingshot releases, the market will not wait for your emotions to catch up. Remember why you bought in the first place. Was it for a quick flip between 70 and 75? Or because you understood that the fiat game is structurally broken, that counterparty risk is code for someone else's promise, and that atoms have no counterparty? Today's price shock does not invalidate that thesis. It validates it. The system literally has to fake a lower quote once a year just to keep its risk metrics from exploding on screen. That's not a sign of strength. That's a sign of strain. If this analysis helped you cut through the noise of today's crash, but make sure you're subscribed, hit the notifications, and stay with the people who actually dissect the mechanism, not the herd that only reads the headline. Hold the line, trust the atoms, not the paper. And get ready for what the first quarter of 2026 does to a market that's been pushed too far below reality for too long. This content is for education and information only. It is not financial advice. It is not a recommendation to buy or sell anything. You must do your own research, talk to qualified professionals, and never risk money you cannot afford to lose. Markets are brutal, but they're also predictable once you see the broken script behind the price.